Imagine this. You're the financial manager of a company. Two projects land on your desk at the same time. One is a new tech product. The other is a new factory. Both look profitable, but you can only afford one. So how do you choose without guessing? That decision is exactly what investment appraisal is designed for. This is the Learning Studio, and today we're breaking down the tools companies use to decide where money should go and where it absolutely shouldn't. At its core, investment appraisal is about discipline. Money is limited. Opportunities are endless. The job is to choose the option that creates the most value. But before any method works, one idea has to be clear. Money today is more valuable than money tomorrow. If you receive cash now, you can invest it, grow it, protect it. Cash received later carries risk, delay, and uncertainty. That single idea drives almost every serious investment decision. That's why the most trusted method is net present value. NPV doesn't ask how exciting a project sounds. It asks one brutal question. After adjusting for time and risk, does this project add value today? If the answer is yes, the project deserves attention. If not, it's rejected, no matter how impressive the headline numbers look. That's why NPV sits at the top of the decision hierarchy. Some managers prefer thinking in percentages. That's where internal rate of return comes in. IRR tells you the return a project generates on its own cash flows. If that return beats the company's minimum required return, the project clears the hurdle. It's intuitive, it's comparable, but it can mislead when projects differ in size or timing, which is why smart firms treat IRR as a companion, not a replacement for NPV. Then there's the simplest question of all. How fast do we get our money back? That's the payback period. It doesn't care about long-term value. It cares about speed. In uncertain industries, quick recovery can matter more than perfect optimization. Each method answers a different concern. Value, return, liquidity. That's why real companies don't rely on just one. Energy giants like Shell use NPV to judge long-term projects, IRR to compare alternatives, and payback to manage risk exposure. Tools don't replace judgment, they sharpen it. And the intellectual backbone behind this thinking traces back to economists like Irving Fisher, whose work on the time value of money shaped how modern finance evaluates future cash flows. Investment appraisal isn't about predicting the future perfectly. It's about making better decisions with imperfect information. In the next video, we'll tackle risk management and capital budgeting under uncertainty. What happens when numbers look good, but the future refuses to cooperate? Subscribe and continue with the playlist. This is the Learning Studio. I'll see you in the next lesson.